Introduction to Diversification and the Concept of Diversification when Benjamin Graham, one of the most respected figures in investment history, advised investors to avoid putting all their eggs in one basket. He wasn't just offering a simple metaphor, he was laying the foundation for one of the most essential principles in investing: diversification. This advice remains as relevant today as it was when Graham first introduced it. At its core, diversification aims to reduce the risks associated with concentrated investments. It's about spreading your financial assets across various investments to mitigate the potential for substantial loss in case one asset, sector, or geographical market underperforms. Diversification isn't just a strategy for safety. It's a strategy that aims for steady and reliable returns over time. Graham believed that by carefully selecting a diversified group of investments, an investor could reduce risk without sacrificing potential returns. In fact, he suggested that diversification should be seen as the first line of defense in investors' toolbox. But why does this matter? And how does it play out in real-world investing? Let's explore. Why is diversification so crucial in investing? Risk is unavoidable, however. Diversification allows you to manage and control that risk more effectively. One of the biggest risks any investor faces is unsystematic risk, the risk unique to an individual asset or company. For example, if an investor has all their funds tied up in a single stock, they are highly exposed to risks such as company-specific issues, poor earnings reports, or even scandals that can wipe out the stock's value. Diversification helps to reduce this type of risk by spreading investments across various asset types, industries, and geographic regions. Imagine a scenario where you own stocks in a tech company, a healthcare provider, and a real estate firm. If the tech industry faces a sudden downturn, your healthcare and real estate investments may remain unaffected or even benefit from the shifting market conditions. By spreading your assets, you significantly reduce the potential damage from market volatility, which is why diversification is key to building a resilient investment portfolio. The concept of diversification that we've established, the importance of diversification. Let's dive deeper into what it actually means. Diversification involves dividing your investments among different financial instruments, industries, and other categories to minimize risk. It helps reduce the reliance on any single investment's performance, thus shielding you from substantial losses. Asset class diversification. Of the primary ways to diversify is through asset allocation. Asset classes are groups of similar investments that share similar characteristics. The main asset classes include equity stocks. These are shares of ownership in companies. Stocks can generate high returns but are also volatile. Bonds are debt securities that pay interest over time and are typically less volatile than stocks. Real estate. Investing in physical properties or real estate funds rights can offer both income and capital appreciation. Commodities. This includes physical assets like gold, silver, oil, and agricultural products. Cash and cash equivalents. This includes savings accounts, money market funds, and other highly liquid investments that are safe but offer low returns. When you invest in a single asset class, you're exposed to the risks associated with that class. For example, the stock market can be highly volatile in the short term, but bonds tend to be more stable. A well-diversified portfolio often includes a mix of these asset classes to balance risk and reward. The objective is to allocate investments in such a way that while one class may be underperforming, another class may be performing well, which stabilizes the overall portfolio. Sector diversification. Bond asset classes. Another key area of diversification is sector diversification. The global economy is made up of various industries, and each one is influenced by different factors. Tech, healthcare, energy, financials, and consumer goods are just a few examples of sectors in which an investor can spread their investments. Let's explore how sector diversification works. Tech sector. Tech stocks can be very volatile, with rapid growth potential. However, they are subject to changes in innovation, regulation, and market sentiment. Healthcare sector. Healthcare stocks tend to be more stable, even in downturns, since people will always need healthcare services. However, certain segments within healthcare, like pharmaceuticals or biotech, can be volatile. Energy sector. The performance of energy companies can be heavily influenced by geopolitical events, environmental regulations, and the fluctuating prices of oil and gas. By holding investments across a wide variety of sectors, you reduce the risk associated with any single sector downturn, even if one sector experiences a significant loss. Other sectors may help offset those losses. This is why sector diversification is vital in constructing a balanced and resilient portfolio. Geographical diversification. A key concept in diversification is geographical diversification. This refers to spreading investments across different regions of the world to minimize the risk tied to any specific country or economic zone. Different countries face unique economic challenges, including political risks, currency fluctuations, and domestic policies that can affect investments. For example, during times of economic downturn in the US, countries in Europe or Asia might experience growth, and vice versa. If you only invest in US-based companies, a recession or market crash in the US could significantly impact your portfolio. However, by diversifying into international markets such as Europe, Asia, or emerging markets, you ensure that your portfolio isn't overly dependent on the economic conditions of one particular country or region. Why diversification doesn't guarantee immunity. While diversification is a powerful risk management tool, it is essential to remember that it doesn't make an investor immune to market losses. It reduces unsystematic risk, but doesn't eliminate systematic risk, which affects the entire market. For instance, during a global financial crisis, all sectors and markets are affected to some degree. However, diversification helps to smooth out the effects and reduce the likelihood of catastrophic losses in any single area. Why diversification matters in modern investing. In today's complex financial landscape, the need for diversification has never been more critical. Market conditions can change quickly, driven by factors such as geopolitical events, technological disruptions, and changing consumer behaviors. A diversified portfolio is better equipped to weather these storms. Take, for example, the 2018 market corrections, when stocks in the technology sector experienced significant declines, but real estate investments and bonds remained relatively stable. Similarly, during the COVID-19 pandemic, certain sectors like healthcare and technology thrived, while others like travel and hospitality were hit hard. Those who had diversified portfolios were better positioned to survive and even thrive during these unpredictable times. In conclusion, diversification is a time-tested strategy that, when implemented correctly, can significantly reduce risk and enhance the potential for long-term growth. Whether you are an individual investor or a professional managing large sums of money, understanding the core principles of diversification is essential to your success in the markets. Approach to investing. Benjamin Graham, often referred to as the father of value investing, revolutionized the way investors thought about markets and investments. He was not a believer in speculation, an approach where investors bet on short-term market movements, but rather in investing with a long-term perspective focused on value. His principles, particularly the concept of margin of safety and diversification, form the foundation of much of modern investment theory. Graham's approach was grounded in fundamental analysis, which involves analyzing a company's financial health, its intrinsic value, and its ability to generate steady returns over time. In stark contrast to the speculative behavior common in his day, Graham's method aimed to reduce risk while maximizing long-term returns. Diversification was an essential element of his strategy, helping investors avoid the pitfalls of concentration in any single asset or sector. The margin of safety and diversification. Graham's philosophy centered on the idea of providing a margin of safety in every investment. He believed that by investing in securities that were priced below their intrinsic value, an investor could limit the downside risk of their investment. This principle is most commonly applied through value investing, where you look for undervalued stocks with strong fundamentals that are trading below their true worth. However, Graham didn't stop at simply finding undervalued securities. He knew that even the best analysis could sometimes go wrong. Therefore, he recommended diversification as a tool to further safeguard the portfolio. Diversification acts as a cushion, preventing the entire portfolio from being adversely affected by a single investment. Mistake. Graham suggested that an investor's portfolio should be broadly diversified across different sectors and asset classes. In his writings, he recommended holding between 10 and 30 stocks to achieve a proper level of diversification. This range allowed for ample protection against individual stock failures, but without the dilution of returns seen in portfolios with too many holdings. Why diversification is key to Graham's strategy. Why diversification is key to Graham's strategy. For Graham, diversification wasn't just a strategy for risk management, it was a crucial part of his long-term investment approach. By spreading investments across various sectors, he believed an investor could avoid the massive losses that come with putting all their eggs in one basket. Graham recognized that markets are inherently unpredictable. He understood that even the best investors can experience occasional failures or unanticipated downturns. By diversifying, investors were better positioned to ride out market fluctuations without suffering catastrophic losses. He often referred to the importance of not relying too heavily on any single stock or sector. For example, if an investor placed all their money into one company, a downturn in that company's fortunes could devastate their portfolio. But if that same investor had diversified into a variety of companies, industries, and asset types, a downturn in one area could be offset by gains in another. The balanced approach. Graham's blend of stocks and bonds. While Graham was known for his focus on stocks, he was also a strong advocate for bond investments, particularly government bonds. His portfolio recommendations typically consisted of a balanced mix of stocks and bonds. He understood that bonds offer stability and steady income, while stocks provide growth potential. Graham recommended that an investor hold a significant portion of their portfolio in bonds, especially if they were nearing retirement or risk-averse. In contrast, younger investors with a longer time horizon could afford to allocate more of their capital into stocks. He advised that investors should rebalance their portfolios regularly, adjusting the stock-to-bond ratio based on changing market conditions and personal circumstances. Graham's rules for diversification. Graham's rules for diversification were straightforward yet effective. His approach focused on reducing risk without sacrificing growth potential. He believed that diversification was the key to achieving both stability and long-term gains. Below are some of Graham's core diversification principles. A well-balanced portfolio. Graham recommended that investors aim for a balance between stocks and bonds. For most investors, this would mean holding a mix of around 50% stocks and 50% bonds. However, the exact balance would depend on individual circumstances, such as risk tolerance, time horizon, and investment goals. Diversify across asset classes. As mentioned earlier, diversification wasn't just about owning different stocks, it was about having exposure to a wide range of asset classes, including bonds, real estate, and other tangible assets. Graham recommended that investors never place too much of their capital into any one investment type. Sector diversification. Graham emphasized the importance of holding investments across a variety of industries. He noted that some sectors are more sensitive to economic cycles than others. For example, during periods of economic growth, technology stocks may perform well, while during economic downturns, defensive sectors like utilities or consumer staples may hold up better. Limit exposure to individual stocks. While Graham acknowledged that it's impossible to predict the outcome of every investment, he stressed that limiting exposure to individual stocks reduces risk. By holding a portfolio of 10 to 30 stocks, investors can significantly reduce the impact of any one stock's poor performance on their overall portfolio. The need for regular rebalancing. One of the critical components of Graham's diversification strategy is rebalancing. Over time, the performance of certain assets in a portfolio may cause the overall allocation to shift. For example, stocks may outperform bonds, resulting in an increased allocation to equities. To maintain the original balance, investors should periodically review their portfolios and rebalance by selling overperforming assets and buying underperforming ones. The evolution of Graham's principles in today's market. Graham's principles, while revolutionary in his time, have stood the test of time and continue to be relevant in today's investing world. However, modern investors now have a wide array of tools and investment vehicles that allow for even greater diversification than Graham could have imagined. Exchange-traded funds, ETFs, and mutual funds. These investment vehicles provide a way for investors to gain exposure to multiple asset classes and sectors with a single purchase. Graham didn't have access to ETFs or index funds, but he would likely have appreciated how these funds make it easier for individual investors to achieve broad diversification without the need to pick individual stocks. Global diversification. Today's investors can diversify not only across asset classes but also across geographies. Graham's principle of geographical diversification remains crucial, but now investors have access to international ETFs, emerging market funds, and foreign stocks that allow them to gain exposure to global markets with ease. Automated investing tools. Robo-advisors. Modern tools such as robo-advisors have made it even easier to diversify portfolios. These platforms use algorithms to build and manage diversified portfolios based on an investor's risk tolerance and financial goals, providing an automated version of Graham's diversified investing strategy. Conclusion: the enduring legacy of Graham's philosopher. Benjamin Graham's emphasis on diversification as a cornerstone of long-term investment success remains as valuable today as it was when he first introduced these ideas. While investment tools and market conditions have evolved, the basic principles of diversification, spreading risk across asset classes, industries, and geographies, are as critical now as ever. By diversifying your investments, you increase your chances of weathering economic downturns, protecting yourself from market volatility, and achieving steady long-term returns. Whether you're a novice investor or a seasoned professional, applying Graham's principles of diversification can help you build a resilient and successful portfolio for years to come. How to implement diversification in a modern portfolio is not just about spreading your investments across multiple assets or sectors. It's about doing so in a way that aligns with your investment goals, time horizon, and risk tolerance. In this section, we will break down the practical steps involved in building a well-diversified portfolio. 1. Determine your risk tolerance before making any investment decisions. It's crucial to understand your risk tolerance, the level of risk you're willing and able to take. Risk tolerance can vary from one investor to another and is influenced by factors such as age, financial situation, and investment goals. Here's how you can assess your risk tolerance. Conservative. If you're nearing retirement or prefer a more stable income, your risk tolerance may be low. You may prioritize capital preservation and would prefer safer investments like bonds and cash equivalents. Moderate. If you're willing to accept some risk for the possibility of higher returns, you might opt for a balanced portfolio with a mix of stocks, bonds, and real estate. Aggressive. Younger investors or those with a higher risk tolerance may be comfortable with a portfolio that has a significant allocation to stocks or even alternative investments like cryptocurrency or private equity. Once you've identified your risk tolerance, you can begin to choose an appropriate asset allocation strategy to match your preferences. This will help guide how much of your portfolio goes into each asset class. 2. Choose a mix of asset classes. The next step in diversification is choosing a mix of asset classes that aligns with your risk profile. As mentioned earlier, a balanced portfolio generally includes a combination of stocks, bonds, real estate, and other asset classes. Here's a breakdown of each. Stocks. Equities. Stocks are typically the backbone of any diversified portfolio, especially for those with a long-term horizon. They offer the potential for capital appreciation, meaning the value of the stock can increase over time, providing investors with growth. However, they are also subject to market volatility. Within the stock allocation, you can diversify further by choosing companies from different sectors: technology, healthcare, finance, energy, and consumer goods, along with stocks from various regions of the world: domestic, international, and emerging markets. Bonds. Fixed income. Bonds are generally considered lower risk investments compared to stocks. They provide regular interest payments and are less volatile. However, the returns from bonds tend to be lower than stocks in the long run. Investors can diversify across government bonds, corporate bonds, and municipal bonds, as well as bonds from different countries or regions to spread risk. Real estate. Real estate can be an excellent way to add diversification to your portfolio. Real estate generally offers both income through rentals and the potential for long-term capital appreciation. You can invest directly by purchasing property or indirectly by investing in real estate investment trusts. Rights provide exposure to real estate without the hassle of managing physical properties. Commodities. Commodities like gold, oil, agricultural products, and metals can serve as a hedge against inflation and market downturns. Commodities typically perform well when stock markets are down or when inflation is rising, which makes them an important part of a diversified portfolio. Cash and cash equivalents. Cash equivalents such as money market funds and short-term treasury bills are safe, liquid investments, while they offer low returns. They provide stability and can be used as a buffer in times of economic uncertainty. 3. Sector and industry diversification. Why diversifying across asset classes is essential. Sector and industry diversification adds another layer of protection. As we've discussed, different sectors of the economy react differently to market forces. For example, technology, high growth potential, but often volatile; healthcare, relatively stable, even during recessions, due to the ongoing demand for healthcare; energy, cyclical, tied to oil and gas prices, and can be impacted by geopolitical factors. Consumer staples, recession-resistant because people need essentials, such as food and household items, regardless of the economic climate. Diversifying across sectors means that a downturn in one area, e.g., tech stocks, may be offset by growth in another, e.g., consumer staples or utilities. Point 4. Geographical diversification. Geographic diversification helps you mitigate the risk tied to a single country's economic conditions. For example, a US-centric portfolio is heavily exposed to the performance of the US economy. By adding international stocks, bonds, and other assets to your portfolio, you reduce your reliance on the economic performance of one country. Domestic versus international investments. It's essential to strike the right balance between domestic and international investments. Developed markets like the US and Europe provide stability, while emerging markets offer growth potential but come with additional risk. Emerging markets. Investors looking for higher returns might consider emerging markets, such as China, India, or Brazil. While these markets carry higher risk, they can offer high growth opportunities, particularly in sectors like technology and consumer goods. 5. Rebalancing your portfolio. Rebalancing is a crucial component of portfolio management. Over time, different investments within your portfolio will grow at different rates. For example, if the stock market performs well, your portfolio may become overweighted in equities, which increases the overall risk. Similarly, if bonds outperform, your portfolio may become too conservative. Rebalancing involves adjusting the allocations of your portfolio back to your original target. This might involve selling some assets and buying others to maintain your desired risk-to-return ratio. Rebalancing should be done periodically, at least once a year or whenever there is a significant shift in market conditions. 6. Using ETFs and mutual funds for diversification. For investors who don't have the time or expertise to pick individual stocks or bonds, exchange-traded funds, ETFs, and mutual funds provide an easy way to achieve diversification. These funds pool investors' money and invest in a broad range of securities across different asset classes, sectors, and geographies. ETFs track specific indices, such as the S&P 500, or sectors like technology or healthcare, and they offer low-cost diversification with flexibility. ETFs are traded on exchanges like stocks, which means you can buy and sell them throughout the day. Mutual funds. Mutual funds are managed by professional portfolio managers who allocate assets based on the fund's investment objectives. They tend to have higher fees than ETFs but provide hands-off management, making them a good option for investors who prefer a passive approach to diversification. Modern tools for achieving diversification. Technological advancements. Modern investors now have access to a wide variety of tools to help them build and maintain a diversified portfolio. Some of the key tools include robo-advisors. Robo-advisors are automated platforms that use algorithms to create and manage a diversified portfolio based on your risk tolerance, time horizon, and goals. These platforms typically offer low fees and can help investors with little to no experience build a diversified portfolio quickly. Portfolio management apps like Wealthfront, Betterment, and Personal Capital allow investors to monitor their portfolios, track performance, and make adjustments as needed to maintain diversification. These apps also provide valuable insights into how well your portfolio is diversified across asset classes, sectors, and geographies. Diversified investment platforms like Vanguard, Fidelity, and Charles Schwab offer a range of diversified index funds and ETFs that make it easy to invest in a broad range of assets without having to pick individual securities. Conclusion: achieving long-term success with diversification is a powerful strategy that can significantly reduce risk and improve the stability of your portfolio. By following the steps outlined in this section, you can build a well-diversified portfolio that aligns with your financial goals and risk tolerance. Whether you're using traditional stocks and bonds, ETFs, mutual funds, or robo-advisors, the key is to maintain balance and ensure that your investments are spread across various asset classes, sectors, and geographies. The psychology of diversification. Behavioral biases in investing. Behavioral biases are inherent flaws in human decision-making that can significantly impact investment choices. These biases arise from emotions, cognitive errors, and social influences that can lead investors to make suboptimal decisions. While diversification is a proven strategy for reducing risk and increasing long-term returns, it is often overlooked or poorly implemented due to various psychological biases. In this section, we will explore the most common behavioral biases that affect diversification strategies and discuss how to recognize and overcome these biases to make better investment decisions. 1. Overconfidence. One of the most common biases that investors face is overconfidence. Overconfidence occurs when investors believe they can outperform the market or pick winning investments better than others, even when they lack the necessary expertise. This leads to excessive concentration in specific assets or sectors, as overconfident investors think they know best. Example: an investor who is highly confident in the technology sector might allocate a large portion of their portfolio to tech stocks, believing that this sector will continue to outperform the market. However, this overconfidence can result in a lack of diversification and exposure to sector-specific risks, such as regulatory changes, market saturation, or technological disruptions. Overcoming overconfidence. To counteract overconfidence, investors must recognize the limitations of their knowledge and embrace the principle of diversification. By spreading investments across different sectors, asset classes, and geographies, investors reduce the impact of their own biases and ensure that they are not overly reliant on one area of the market. 2. Loss aversion. Loss aversion is a well-documented psychological phenomenon where people feel the pain of losses more intensely than the pleasure of equivalent gains. This bias can lead to suboptimal investment choices, especially when it comes to diversification. Example: an investor who has experienced a significant loss in a particular stock or sector may be hesitant and to sell that asset, even if it is underperforming. The fear of realizing a loss can cause the investor to hold on to an asset for too long, neglecting opportunities for better diversification. Overcoming loss aversion. To mitigate loss aversion, investors should adopt a more disciplined approach to investing, which includes setting clear goals and adhering to a well-thought-out investment strategy. Regularly reviewing and rebalancing the portfolio can help avoid emotional attachment to losing investments and ensure that the portfolio remains diversified and aligned with long-term objectives. 3. Herding behavior. Behavior refers to the tendency of individuals to follow the crowd, often ignoring their own analysis or logic. In investing, this can lead to an overconcentration in popular sectors or assets driven by the actions of other investors rather than sound fundamentals. Example: during a market rally, such as the dot-com bubble in the late 1990s or the cryptocurrency Boom in the 2010s, investors flocked to what seems to be the next big thing without considering the risks. This herd mentality often results in an asset bubble, where the price of a stock or sector is driven up far beyond its intrinsic value, overcoming herding behavior. To combat herding behavior, investors must stick to their own investment strategy and avoid chasing trends. Diversifying across different sectors and asset classes ensures that an investor is not overly exposed to one sector that may be experiencing irrational exuberance. By focusing on long-term fundamentals and staying disciplined, investors can avoid the pitfalls of herding behavior. *4 Familiarity bias. Familiarity bias occurs when investors feel more comfortable investing in assets or sectors they are familiar with. This bias leads them to concentrate their portfolios in industries or companies they know well, often at the expense of broader diversification. Example, an investor who works in the technology sector may feel more confident investing in tech stocks because they have first-hand knowledge of the industry. While this may seem logical, it can lead to a lack of diversification, as the investor may overlook other sectors that could provide more stability or growth. Opportunities. Overcoming familiarity bias. To overcome familiarity bias, investors must make a conscious effort to diversify their portfolios. It's important to consider other sectors, asset classes, and geographical regions, even if they are outside ones. Immediate expertise. This can help reduce exposure to sector-specific risks and provide a more balanced portfolio. 5. Anchoring bias. Anchoring bias occurs when investors fixate on a particular piece of information, such as the price they paid for an asset, and use it as a reference point for future decisions. This bias can cause investors to hold onto assets that are no longer aligned with their goals or strategy. Example, an investor who purchased a stock at $100 may be reluctant to sell it at a loss when the stock price drops to $50, even though the stock may no longer fit within their diversified strategy. The initial price becomes an anchor that prevents the investor from making rational decisions based on the current market conditions. Overcoming anchoring bias. To overcome anchoring bias, investors should focus on the current value and future potential of an asset, rather than the price they initially paid. It's important to regularly reassess the value of each asset within the portfolio and consider how well it fits with the overall diversification strategy. 6. Mental accounting bias. Mental accounting is a bias where investors treat different pools of money separately, often categorizing them based on their source or purpose, rather than integrating them into an overall portfolio strategy. This can lead to a lack of diversification, as assets are placed into buckets that don't necessarily align with the investor's overall risk tolerance. Example, an investor may have a separate account for retirement savings, which is invested conservatively, and another for their children's education, which is invested aggressively. However, the overall portfolio may be poorly diversified because the investor is not considering the entire picture when making decisions. Overcoming mental accounting bias. To overcome mental accounting, investors should view their entire portfolio as one cohesive unit. By understanding the overall risk profile of the entire portfolio, investors can make more informed decisions about diversification and ensure that all assets are properly allocated. How to avoid biases and stick to diversification. Ginseng and overcoming these behavioral biases is key to maintaining a well-diversified portfolio. Here are some strategies that can help you stay on track, set clear goals, and stick to a plan. Having a well-defined investment plan can help you make objective decisions, reducing the impact of emotions or biases. Define your long-term goals, risk tolerance, and asset allocation, and stick to the plan even when the market is volatile. Regularly rebalance your portfolio. Rebalancing is a critical component of maintaining diversification. Periodically review your portfolio and adjust your investments to ensure they align with your original strategy. Rebalancing helps to avoid overconcentration in any one asset or sector. Seek professional advice if you find that your biases are influencing your investment decisions. Consider seeking advice from a financial advisor. A professional can provide an objective perspective and help you build a diversified portfolio that aligns with your goals. Automate your investments. Automating your investments through tools like robo-advisors or automatic contributions to diversified funds, can reduce the impact of emotional decision-making. These tools help ensure that you are consistently investing in a diversified manner without being swayed by short-term market fluctuations. Conclusion: mastering the psychology of diversification biases can significantly impact your ability to implement a diversified investment strategy. By recognizing these biases and adopting strategies to counteract them, you can make more rational investment decisions and build a portfolio that is aligned with your long-term goals. Diversification remains one of the most powerful tools in managing risk, but it requires discipline and self-awareness to avoid common psychological pitfalls. Real-life case studies of diversification in action. Case study 1. Warren Buffett and Berkshire Hathaway. Warren Buffett, widely regarded as one of the most successful investors of all time, is a strong advocate for diversification, though his approach differs from the traditional idea of owning many individual stocks. Buffett's company, Berkshire Hathaway, exemplifies the benefits of diversification through ownership rather than just investment. By acquiring entire companies and building a portfolio of diverse business operations, Buffett has created one of the most diversified investment vehicles in the world. Buffett's diversification strategy. Buffett's approach to diversification is not about owning thousands of stocks, but ensuring his portfolio spans multiple industries, creating natural diversification. Berkshire Hathaway owns stakes in a wide array of businesses, from insurance Geico to energy Berkshire Hathaway Energy to consumer goods Coca-Cola, and even railroads BNSF Railway. Each of these businesses operates in distinct sectors, reducing risk through diversification. Lesson: Buffett's strategy demonstrates that diversification doesn't necessarily mean spreading investments across hundreds of stocks. Instead, strategic diversification, investing in businesses that operate in different sectors, can be just as effective, if not more so, in reducing risk and maximizing long-term returns. Why this works: Buffett's diversified portfolio allows him to take advantage of growth opportunities in different sectors while minimizing the risk that comes from a downturn in any one industry. For example, while the airline industry faced challenges during the pandemic, Berkshire Hathaway's insurance and energy businesses continued to perform well, ensuring overall portfolio stability. Case Study 2. The dot-com bubble 1997-2000. In the late 1990s, the dot-com bubble reached its peak, characterized by the rapid rise of internet-based companies. Many investors, eager to capitalize on the internet boom, poured large sums of money into tech stocks, creating a market bubble that eventually burst in 2000. Lack of diversification and overconfidence. Investors during the dot-com bubble suffered greatly due to the overconcentration of their portfolios in tech stocks. Many believed that the internet revolution would continue to deliver high returns indefinitely, leading them to ignore basic principles of diversification. When the bubble burst, tech stocks plummeted, leaving those heavily invested in the sector with massive losses. Lesson: this case highlights the dangers of failing to diversify and the risks of being overly confident in a single sector. The bubble's collapse could have been mitigated with a more balanced portfolio that included investments in other sectors like healthcare, consumer goods, or financial services, which were less affected by the downturn in tech stocks. What went wrong? Investors ignored the principles of diversification and rational risk assessment, driven by herd mentality and overconfidence, instead of spreading risk across different sectors and assets. They placed their trust in the assumption that the tech sector's growth would continue forever. When the bubble burst, they were left vulnerable to the collapse of a single, volatile industry. Case Study 3. The Global Financial Crisis, 2007-2008. The Global Financial Crisis, GFC, of 2007-2008 was one of the most significant economic events in recent history. During the crisis, investors experienced massive losses due to the collapse of the housing market and widespread failures in the banking sector. However, not all investors suffered equally. Diversification in action. The role of bonds. Investors with diversified portfolios that included bonds and real estate fared better during the crisis than those who had concentrated their investments in the stock market. For example, investors who held a mix of US Treasury bonds considered safe haven assets saw their value rise as investors flocked to safer investments amid the uncertainty. On the other hand, those who invested heavily in subprime mortgage-backed securities or banks with significant exposure to risky mortgages saw devastating losses. Lesson: the GFC illustrates the importance of diversification across asset classes. Having a portion of the portfolio in bonds, real estate, or other stable assets can protect against massive losses during periods of market turmoil. Asset allocation, not just sector or geographical diversification, is essential for minimizing risk in volatile times. What worked and what didn't? While stock-heavy portfolios suffered the brunt of the financial meltdown, diversified portfolios that balanced equities with safer investments, like bonds or commodities, were better positioned to weather the storm. Diversifying between riskier and more stable assets can protect investors from large-scale market disruptions. Case study 4. The rise of ETFs and index funds. Introduction of exchange-traded funds. ETFs and index funds has been a game-changer for individual investors seeking diversification. These funds allow investors to access a broad market index like the S&P 500 or specific sectors with a single investment, providing automatic diversification without the need to pick individual stocks. Success through broad market exposure. Investors who adopted ETFs and index funds early on benefited greatly from the diversification these products offer. For instance, the Vanguard 500 Index Fund, which tracks the S&P 500, has provided long-term returns that mirror the performance of the broader market, benefiting from the growth of the largest and most diversified companies in the US. Lesson: ETFs and index funds are modern tools that make diversification more accessible to all investors, regardless of their knowledge or expertise. Rather than trying to pick individual stocks or sector-specific investments, investors can achieve broad market exposure with a single fund, ensuring that their portfolio is well diversified. Why ETFs and index funds work. The main advantage of ETFs and index funds is that they provide exposure to a wide range of asset stocks, bonds, or even commodities at a relatively low cost. They automatically adjust to changes in the market, ensuring that the portfolio remains diversified without requiring constant monitoring or rebalancing. Case Study 5. The collapse of Lehman Brothers and the importance of sector diversification. Brothers, a global investment bank, collapsed in 2008 after its exposure to subprime mortgages caused its downfall. Many investors had significant exposure to Lehman's stock, thinking it was a reliable institution, but they were unaware of the enormous risks hidden in its mortgage portfolio. Sector concentration risk. Lehman's collapse underscores the danger of sector concentration. Investors who had significant holdings in the financial sector and specifically in Lehman Brothers faced massive losses. Those who had diversified into other sectors, such as consumer goods, healthcare, and energy, were able to avoid the worst of the fallout. Lesson: the collapse of Lehman Brothers highlights the importance of diversifying across different sectors, especially sectors that are not correlated to one another. The financial crisis taught investors that even seemingly solid companies could fail under unexpected market conditions, and a diversified portfolio could help mitigate these types of risks. The impact of lack of diversification and bankruptcy also illustrates how lack of diversification, whether in sector or asset class, can expose investors to greater risk. Investors who concentrated their portfolios in financial stocks, particularly in institutions with high leverage, faced devastating losses. Those who balanced their portfolios with investments in non-financial sectors, on the other hand, were better able to endure the storm. Conclusion: key takeaways from real-life case studies. Case studies discussed above illustrate the profound impact diversification or lack thereof can have on investment outcomes. From the success of Warren Buffett's diversified Berkshire Hathaway to the failures of overconfident investors during the dot-com bubble and the global financial crisis, we see that diversification is key to managing risk and achieving long-term success, whether through sector diversification, asset class diversification, or utilizing modern tools like ETFs and index funds. Investors can protect themselves from unexpected market downturns and ensure steady growth. The key is to avoid overconfidence, herding behavior, and sector concentration, and to embrace a well-rounded investment strategy that accounts for risk across various areas. The future of diversification. AI and machine learning. Diversification has always been a cornerstone of effective investing, but as markets become more complex and interconnected, the tools and strategies used to achieve diversification are evolving. In recent years, artificial intelligence (AI) and machine learning (ML) have emerged as powerful tools for investors, helping them make data-driven decisions and optimize their portfolios with greater precision. AI and machine learning are already transforming industries across the globe, and investing is no exception. These technologies enable investors to process vast amounts of data, identify patterns, and make predictions about future market movements. By harnessing the power of AI and machine learning, investors can take diversification to the next level, improving risk management and enhancing portfolio returns. In this section, we'll explore how AI and machine learning are shaping the future of diversification, what benefits they offer, and how investors can leverage these technologies to optimize their portfolios. How AI and machine learning enhance diversification. AI and machine learning help investors by providing tools that allow for more sophisticated analysis and decision-making. These technologies can assist with a variety of tasks in portfolio construction and management, including 1. Advanced data analysis and predictive modeling. AI and machine learning algorithms can analyze vast amounts of data from different sources such as financial reports, market trends, news, and social media to identify patterns and predict market movements. This allows for more informed decisions when selecting assets for a diversified portfolio. Example, AI can predict which sectors are likely to perform well based on macroeconomic data, geopolitical events, and industry trends. For instance, AI detects that a particular country is likely to experience economic growth due to favorable government policies or technological advancements. It may recommend increased exposure to that region's stocks, bonds, or commodities. This predictive capability enables investors to better anticipate market shifts and diversify their portfolios more effectively. 2. Optimization of asset allocation. Asset allocation, the process of deciding how to distribute investments across asset classes, has been based on static models, often relying on historical data and general rules of thumb, e.g., 60% stocks and 40% bonds. However, AI and machine learning can optimize asset allocation dynamically, adjusting for market conditions, risk profiles, and investor goals in real time. Example, machine learning algorithms can analyze an investor's past behaviors, preferences, and risk tolerance to generate a tailored portfolio. AI can then continuously adjust asset allocation based on real-time market data, ensuring the portfolio remains diversified and aligned with the investor's goals. This dynamic allocation can help reduce risk and maximize returns, as it responds to market fluctuations much more quickly than a human manager could. 3. Identifying hidden diversification opportunities. AI and machine learning can uncover diversification opportunities that may not be immediately obvious to human investors. By analyzing correlations between different asset classes, sectors, and markets, AI can identify investments that complement each other in ways that might not be immediately apparent. Example, AI can detect correlations between stocks and commodities in different geographic regions or sectors that can help improve diversification. For instance, AI might suggest combining investments in emerging markets with commodities like gold or oil, which often behave differently from stocks during market downturns. This approach could improve risk-adjusted returns by incorporating assets that move independently of each other, reducing the overall volatility of the portfolio. 4. Risk management and stress testing. AI can enhance risk management by conducting advanced stress tests on portfolios, simulating how different assets will perform under various market conditions. This allows investors to see how their diversified portfolio would fare in extreme situations, such as a financial crisis, economic downturn, or geopolitical event. Example, Machine learning can simulate how a portfolio would react to various scenarios, such as a market crash or a sudden interest rate hike. Based on these simulations, I can recommend adjustments to the portfolio to ensure that it remains well diversified and resilient, even under extreme conditions. This predictive power can help investors better understand the potential risks of their portfolios and take proactive steps to mitigate them. 5. Automating portfolio management. One of the key advantages of AI is its ability to automate investment processes. This includes not only asset allocation, but also portfolio rebalancing, tax optimization, and monitoring of asset performance. AI-driven robo-advisors can manage a diversified portfolio on behalf of investors, ensuring it remains balanced and aligned with investors' goals. Example: robo-advisors powered by AI can continuously monitor and adjust a portfolio, ensuring that the correct proportion of stocks, bonds, and other assets is maintained. For instance, if the stock market performs exceptionally well, the AI will rebalance the portfolio by selling some of the stocks and reinvesting the proceeds in underperforming assets, such as bonds or real estate, to maintain the desired risk profile. 6. Improving emotional decision-making. Human emotions, such as fear and greed, often influence investment decisions, leading to impulsive actions that can disrupt diversification strategies. AI, on the other hand, is objective and can help investors stay disciplined by making decisions based solely on data and predetermined criteria. Example: AI can prevent an investor from abandoning a diversified portfolio during a market downturn, a common mistake driven by fear. Instead of reacting emotionally to market volatility, AI can help investors stick to their long-term strategy, ensuring that diversification remains intact and that short-term market fluctuations don't disrupt their overall investment plan. Benefits of using AI and machine learning for diversification. AI and machine learning offer several advantages over traditional diversification strategies. 1. Precision and efficiency. AI can process and analyze large amounts of data at speeds and accuracy levels far beyond human capabilities. This allows for more precise asset allocation, better risk management, and faster adjustments to market conditions. As a result, investors can make more informed decisions, often faster and more efficiently than traditional methods would allow.